Bears have been calling this bull run over since even before the halving. Dismissing the all-time high set after the ETF approvals is not really a new all-time high when adjusted for inflation, and then piling on the "I told you so's" when the price retraced after the hype. I have lost track of exactly how many times I have said on this podcast that I would not expect this cycle to even get rolling until later this summer or early fall. And while we won't know for sure if my, not really prediction, but expectations pan out or not, at least for a little while longer, I think it is safe to say that nobody even remembers the 58K gang anymore.
This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy.
Guten Tag, buenos dias, morgen, and welcome to episode 223 of the Bitcoin Bulletin Podcast. So, do you remember the 58K gang? Remember when Bitcoin was stuck at 58,000 and the bull run was over? I know, it seems like ancient history with Bitcoin well over 100,000 US dollars at the moment and basically hovering there for more than a month with the minor exception of just a few hours last week or so. Well, in the category of the more things change, the more things stay the same, I was hearkening back to our very first Bitcoin Bulletin podcast almost 4 years ago on July 25th, 2021. And surprise, surprise, all that everyone was talking about at the time was the price and that the bull run was already over. As you recall, if you were around back then anyway, Bitcoin had set a new all-time high after the Elon Musk pump in the spring, and that was around $66,000, and then Bitcoin retraced all the way back down to the high $20,000 range before later resuming its regularly scheduled bull run. But at the time, even Plan B, who was calling for $250,000 Bitcoin in the 2021 bull run, even Plan B was tweeting, quote, "Break or bounce, that is the question." And of course, Bitcoin continued to rally through the summer and fall, ultimately hitting that cycle's blow-off top at around $69,000. Well, I guess that wasn't quite the cycle all-time high, but it was the blow-off top for the bull run, the post-halving bull run. We had a little bit of a shake-up before the 2024 halving with the ETF mania, but we'll get to more of that in just a minute. So, while of course it's a little premature looking back on 4 years of Bitcoin Bulletin since we haven't quite hit that 4-year mark yet, let's revisit where we were that summer because I really think it'll help us understand where we find ourselves today. So our very first ever Bitcoin Bulletin podcast was a weekend podcast and it was on, I believe it was Saturday. It was July 25th, 2021, so almost 4 years ago. At the time, we were at block height 692,602. So more than 200,000 blocks since the first Bitcoin Bulletin podcast. And everybody had been talking about the dip into the $29,000 range. But at the time of that episode, Bitcoin had already started its recovery and was at a price of $34,101 US dollars. And of course, it would more than double before that cycle was all said and done. A few days later, our first DCA Wednesday episode was July 28th of 2021, and Bitcoin had gained more than $5,000 over those 3 days, and it was at $39,716.40. Because even though history doesn't repeat, it certainly does rhyme, and each of the previous halving cycles, we've seen Bitcoin really begin its not even its parabolic run in July, but finally starting to show some solid upward movement towards the end of July. Of course, we're not even there yet. And then it was August, for example, in August of 2017, when Bitcoin basically doubled in price. And then, of course, the previous The 2017 cycle had its ultimate blow-off top in December. The cycle after that, the 2020 halving cycle, had its blow-off top in November. Still approximately the same number of blocks from the halving, because the halving came up almost a month earlier in 2020 than it did in 2016, because, well, as the hash rate increases and the network, the difficulty adjustments have to be continuously ratcheted up because blocks are continuously coming in faster than that 10-minute average, and that moves the block, it moves the halving time forward, because the halvings are based on 210,000 blocks, not on 4 years of human time. So as the halvings have moved forward a couple of weeks or a month each cycle, the blow-off tops have correspondingly moved forward approximately a month earlier each halving. And I would expect something similar to happen this time, unless, of course, we do finally get that mythical super cycle. I would not hold my breath. Yes, a lot of things are different this cycle with the ETFs and the corporate treasuries and even the beginnings of nation-state FOMO, but, there's something cyclical about human nature, and there's definitely something cyclical about the halving, Bitcoin's programming, so I wouldn't discount that quite yet. They've been calling for the super cycle basically the entire time I can remember. I remember even in 2016, the 2016 halving, that's the first time I heard the term super cycle, and they were calling for that to be the final Bitcoin cycle, and of course that didn't happen. The same thing went for the 2020 halving. People were calling that the final cycle, and of course that didn't happen. So anything's possible. There are a lot of things that are certainly different this time around, but I wouldn't hold my breath. I think we have at least one more cycle left in us. If not, we see some sort of cycle forever, because again, human nature is cyclical, even if the effect that the halving has eventually becomes smaller and smaller. All right. We do have some actual Bitcoin news to talk about today, but before we get to that part, let's take our customary look at Bitcoin's vital statistics. At the time of this recording, we're sitting at a block height of 903,736, and Bitcoin is ringing in at 109,000 US dollars even. That is up quite a bit. Bitcoin, last time I checked when I started doing the show notes, was in the mid $108,000 range, and it had been kind of seesawing between maybe 108,500 and then down to 108,100 most of that time, but apparently we've just broken the $109,000 mark. That is the second highest US dollar value we have seen on a DCA Wednesday. Obviously, it's not the all-time high, but I often say zoom out, and the nature of this podcast being once weekly on Wednesdays is that we look at the statistics on a weekly basis. So we're zoomed out to the higher altitude of a 1 week perspective. And along those lines, this will also be the second fewest number of sats that we will receive for every dollar we convert into Bitcoin. Currently, $1 will purchase you 917 Satoshis. And of course, the more expensive Bitcoin gets in fiat terms, which really means the less valuable fiat gets in Bitcoin terms, well, less valuable fiat gets in general as it's continuously debased. But the less valuable fiat gets, the fewer Satoshis it will purchase you. And that is a trend that will continue until fiat goes to zero, not just in Bitcoin terms, but ultimately in zero in general, because fiat currencies have always trended towards zero throughout their history. The US dollar has certainly had a good run, but it's already been more than 50 years since the United States left the gold standard and became a fully fiat currency. Of course, it was a fiat currency longer than that, because the gold was backed in dollars in theory, in law only, not in reality, because the United States and the other countries that were on the Bretton Woods Agreement had been debasing their currency and violating that Bretton Woods Agreement for many, many years, which ultimately led to the U.S. having no choice but to abandon the Bitcoin standard. I'm sorry, the gold standard. Bitcoin's current US dollar value gives it a market cap of $2.17 trillion. Obviously, that's the second highest market cap in DCA Wednesday history as well. The previous highest market cap was on the DCA Wednesday on May 21st, when Bitcoin had a $2.18 trillion market cap, something which I fully expect Bitcoin to surpass in the next week or so. But only time will tell. Obviously, I don't have a crystal ball. I'm just going on that hunch, that feeling in the loins, so to speak, based on having been around for a cycle or two, and the fact that this cycle really feels a lot like the 2016 cycle to me. I've said multiple times how 2025 felt more like 2017 than 2021. Obviously, to fully play out like 2017, Bitcoin would have to go to more than $2 million this cycle. I think that's probably unrealistic, but I think you ain't seen nothing yet. Only time will tell, of course, but I wouldn't expect this bull run to be over for a couple of more months and for Bitcoin to make its biggest gains yet of the cycle in the months to come. They say you get Bitcoin at the price you deserve, and if you're a gold bug, that price is currently 32.5 ounces of gold to purchase just one Bitcoin, as even gold trends to zero in Bitcoin terms. For those of you who value wealth in something a little more practical, one Bitcoin will currently purchase you 6,096 large pepperoni pizzas from Papa John's. To put that into perspective, if you purchased one pizza every day, it would take you more than 16.7 years to spend one whole Bitcoin. And that would be if Bitcoin froze at its $109,000 value, because, of course, as Bitcoin goes up in value, pizzas trend to zero in Bitcoin terms. And by the end of this bull run, we're probably going to be talking more than 10,000 large pepperoni pizzas for just one Bitcoin. And, of course, every 4 years, as we have a new cycle, a new halving-induced bull run, that number of pizzas will increase again to the point that over the next 16 years, which is more than 4 cycles from now, eventually you'd get to the point where you're talking Satoshis, minuscule number of Satoshis to purchase one Bitcoin, as your Bitcoin accelerates in fiat value faster than you can eat that pizza. That metric that you know has been my favorite for most of this podcast history, Bitcoin's 24-hour average transaction rate, is zooming right along with a current average of 4.23 transactions per second. I know that's a little skewed because there are more spam transactions on the network than there were. Well, there were almost no spam transactions on the network when we first started this podcast. But since then, we've seen, the ordinals and the inscriptions and the BRC20 tokens, that kind of shenanigans. But prior to that, anytime we saw Bitcoin transactions above 3.14 to 3.15 transactions per second, Bitcoin was usually on a bull run. And if we saw fewer than 3.14 transactions per second, we were usually in a bear market. I think it's safe to say that number is shifted higher. But at the same time, even though there's more spam on the network, as I've repeatedly mentioned, a large portion of the transactions that plebs are making have shifted to the Lightning Network or other second layer solutions. And so there would be more than 4.3 transactions per second on chain. If, for example, people at Steak and Shake purchasing burgers and tallow fries with Bitcoin at this very moment, they can't make an on-chain transaction. Steak and Shake only accepts Lightning transactions, so those are not reflected in that number. But it's still fun to look at that metric. It's still, even if it's just for a general observational purpose. Of course, that was never any kind of official transaction analysis. I think TA is voodoo anyway. Nobody has a crystal ball, and there's no set of numbers and lines you can draw on a chart to predict what the price of Bitcoin will be tomorrow. It's just fun to look at. If nothing else, it shows that there's healthy on-chain activity, which means there's healthy Bitcoin use and healthy Bitcoin adoption. Speaking of on-chain activity, the Bitcoin mempools are a lot clearer than they were last Wednesday. Last Wednesday, we saw a spike more than tenfold in the amount of transactions in the mempool over the previous Wednesday. That has subsided substantially. Currently, Clark Moody's dashboard is showing 2,096 transactions in his mempool, down from 12,785 last week, but still more than double the 984 the week before that. Mempool.space telling a similar story with 2,105 transactions in their mempool. That's still less than 2 full blocks of transactions, though, so mempools are relatively clear. Along those lines, if you do need to make an on-chain transaction, not a Lightning transaction, unless, of course, you're talking about opening or closing Lightning channels, Clark Moody's fee estimator is recommending a fee of 2 sats per VByte to guarantee that that transaction is included in the next block or two. However, they are saying that a fee of just 1 sat per VByte will be mined in a day. That certainly reflects on what I'm looking at, because I'm looking at the last couple of blocks. And well, the last couple of blocks came in a little slower than the previous blocks. If you go back 5 blocks ago, the block was less than a third full, and there were plenty of 1 sat per VByte transactions included in that block. And there's still less than 1.5 blocks where the transaction's pending now. So it seems reasonable that 1 sat per VByte transactions should clear relatively quickly, unless we see just a surge in on-chain activity. Mempool.space is also recommending a fee of 2 sats per VByte for a high priority transaction. That works out to 31 cents in US dollar terms. So if you're looking at consolidating some UTXOs, or if you have to make an on-chain transaction that you need confirmed right away, 31 cents is nothing. I mean, that's nothing considering, if you were to try and send a wire transfer, for example, it would cost you a heck of a lot more than that. Again, mempool.space is saying that a medium, low, or no priority transaction can include a fee of just 1 sat per VByte. So if you do need to send an urgent transaction, before you lowball a fee or before you overpay, make sure you have the latest data from at least 2 different sources. I like Clark Moody and mempool.space for my fee estimating needs. They've never steered me wrong. Of course, I also look at what the last blocks had included and whether or not we've seen a temporary slowdown in the previous blocks that might influence that fee estimator. But if you don't know what you're doing, don't try and lowball it. If you don't know how to bump that fee later with replaced by fee or child pays per parent, or maybe even mempool.space's transaction accelerator, because I wouldn't want your transaction to get hung up and never confirmed. Last DCA Wednesday, we were looking at an imminent difficulty adjustment and the difficulty it takes to mine Bitcoin. We were looking at an adjustment downward of anywhere between 6.4 and 8.5%. And of course, there were conspiracy theories as to why that was. We did have a 7.5% difficulty decrease, and we're now not quite halfway. We're just barely in to the new mining epoch, difficulty epoch. If you don't know, Bitcoin automatically adjusts the difficulty that it takes to find the next block every 2016 blocks, with the goal of having one block come in having blocks come in at an average of once every 10 minutes. Sometimes they come in a lot slower and sometimes they come in a lot faster, which is why they want a large data set, or Bitcoin wants a large data set. I keep saying they, that's just kind of a Freudian slip, I guess, because there is no they in Bitcoin, unlike other altcoins that have foundations that do make these decisions. Bitcoin does not, so it's the protocol that is looking to see that 10-minute average. I mentioned earlier that for the entire history of Bitcoin, we're usually looking at difficulty increases because more computers are being added to the network, more ASICs, more mining machines, and those machines are getting ever more powerful. But from time to time, like last time, we do have decreases. But it looks like we're going to make up for that decrease in record time, because looking ahead to the next difficulty adjustment in about 9.5 days, sometime around July 13th, well, depending where you get your data, it's going to be either a modest increase of as little as 0.2% to as much as a 5.1% increase or more, obviously taking back the majority of that decrease. And I wouldn't be surprised if we find that the increase is going to be even higher, because currently blocks are coming in on an average of 9 minutes and 32 seconds, almost 30 seconds, 28 seconds faster than that 10-minute average. And we've seen the estimated hash rate go back up to almost where we were before last DCA Wednesday. Currently is estimated they're 877.8 exahash securing the network. If you remember, there was a conspiracy theory that Iran had been mining Bitcoin, and that maybe they had Bitcoin miners in the mountain where the nuclear site was, and that when the United States used those bunker busters to take out that nuclear site, that had taken out a significant portion of network hash rate. And then I offered the alternative, that was that there was a heat wave, the so-called heat dome in the United States, and that there was a heavy demand for electricity in Texas, for example, as a result, and that the miners in Texas have those demand reduction agreements with ERCOT, with the grid operator, where they agreed to turn off their miners and let the power flow to other customers. Of course, they get paid to do so. And we've seen that in the past, both in heat waves and in cold snaps, when electricity is in high demand or not even available, like when the windmills were frozen solid, even before there was the demand response agreement, and the miners had to shut off because there was no power, not even because of a demand response reduction. But it looks like things have eased in Texas, and some of those miners have turned back on, and magically, network hash rate has returned to normal. Before we get into the news, I want to take a minute to thank those of you listening on your favorite Podcasting 2.0 apps, such as Fountain. Podcasting 2.0 allows you to contribute value back to your favorite podcasts by either streaming sats on a minute-by-minute basis, kind of a set it and forget it, where you determine what value you think you're receiving by listening to the podcast, and stream that value back in the form of Satoshis, whether that's just 1 sat a minute, or whether it's 10, 20, 100 sats per minute. Again, that's a you do you thing. Or my favorite method, which is by sending a boost. And a boost, of course, is like a shout out. It's a one-time support, a one-time contribution back to the podcast, where you determine how many sats you want to send back, and you send a Lightning transaction with a message, basically a shout out, saying hello, or announcing something important that's going on in your life and your community, or critiquing the podcast, or giving kudos to the podcast, or whatever you want to say. But because it is a Lightning transaction, you're sending value back in the form of Satoshis. And when we do receive boosts, we read them on the following episode of the Bitcoin Bulletin Podcast. And speaking of our listeners, our geographic distribution listeners has remained ossified. Our top 10 countries where our listeners are located remains as follows. Number 1 remains the United States, where slightly more than 50% of you are listening. So hello and thank you to my fellow Americans, especially as we head into this holiday weekend where we celebrate the birthday of the United States on the 4th of July. Number 2 remains Singapore, so apa kabar. Thank you to those of you listening in Singapore in numbers sufficient to keep you at the number 2 position. Number 3 remains Germany, so Dankeschön, mein Freunds in Deutschland. Number 4 remains Argentina, so hola, muchos gracias amigos in Argentina. Number 5 remains Luxembourg, so guten Tag, Dankeschön, mein Freunds in Luxembourg, or Morien for those of you who speak Luxembourgish. Number 6 remains Canada, almost went backwards there, kind of Monty Python-esque. The number of the count shall be 3. Number 6, of course, is Canada. So hello and thank you to those of you listening up north, where you just celebrated Canada Day, which is kind of similar to the 4th of July, but the Canadian version. Number 7 remains the United Kingdom. So hello and thank you to our friends across the pond. Number 8 remains Spain. So hola, muchas gracias amigos in Spain. Number 9 remains Australia. So hello and thank you to those of you listening down under. And number 10 remains Mexico. So hola, muchas gracias amigos in Mexico. Speaking of our listeners, I was getting into the stats a little bit because Spotify, who hosts this podcast, not a sponsor of the show. We originally were hosting our podcast with Anchor.fm, but they, of course, got purchased by Spotify, and as a result, we're now hosted on Spotify. So I've been complaining about the quality of their statistics. I think they're manipulating their statistics in a way to encourage me to say, hey, please listen on Spotify, something I'm not going to do. I encourage you to listen on Podcasting 2.0 platforms, not on Spotify. And I don't know too many podcasters that listen to any podcast on Spotify other than maybe Joe Rogan out of necessity. So looking at those statistics, and this doesn't mention what percentage of listeners are listening on Spotify, but the overwhelming number of listeners are listening on Apple Podcasts, where 52.2% of you are listening. Only 13.3% of you are listening on Fountain. So for those of you not listening on Fountain, you don't have to contribute value back to the podcast you're listening to. That is completely optional. If you don't have the sats to spare, or you don't feel like the podcasts are worth contributing back to, then by all means, you don't have to. But you should support Podcasting 2.0, and you should listen to Podcasting 2.0, because you can even earn sats by listening to podcasts Fountain. So if you're listening to a Bitcoin podcast, it would seem like a no-brainer that you would listen on a podcast where you could actually earn some Satoshis, but only 13.3% of you are doing so. 17.7% of you listening on undisclosed web browsers, and it doesn't break that down into how many of you are listening on Spotify, but I would assume it's probably not that many. An example of why I think the stats are skewed is the next demographic, where it breaks our podcast listeners down by the age. Now, it's not the age that leads me to believe this is an unreliable statistic. It's the fact that 100% of our listeners are grouped in the age 45 through 59, which is solidly Gen X. I've spoken often how I think a large percentage of Bitcoiners are Gen X. It was Gen Xers that invented Bitcoin. I know the millennials were the first really tech native generation, growing up in a world where they don't remember a world before computers, and of course Generation Z, some of them growing up in a world where they can't even remember a world without Bitcoin. So it makes sense that they will be more likely to adopt Bitcoin. But again, most of the Bitcoiners I know are Gen Xers. I see an awful lot of gray hair when I look at the videos of the different conferences around the world. The reason why I think this is a bad statistic is because, again, it says 100% of our listeners are in the 45 to 59 age group, and 0% are in the unknown bracket. And I would expect a good chunk of listeners to be in the unknown, because Fountain doesn't know how old I am. When I'm listening to the podcasts, I would show up in the unknown category. So I don't think it's possible that 100% of our listeners are in that age bracket, or even if they are, some of them should be listening relatively anonymously, and Spotify shouldn't even know that. All right, on to the news. Of course, the price tends to be the news quite a bit, and we already spoke about that when we talked about the 58K gang and how Bitcoin seemed to be stuck in the $107,000 range, which it currently is not. But before that, it seemed like Bitcoin was stuck in the $83,000 range. And before that, remember the 58K gang, with Bitcoin being seemingly stuck in the $58,000 range. Of course, those were all very small portions of time. For example, Bitcoin has been over $100,000 for well over 1% of its entire history now. But I digress. There is actual news to talk about. And the first item was actually news from last Wednesday, but I think it's relatively important, and it's important that I delve into this a little bit, because I think it's something a lot of Bitcoiners don't actually grok. I've heard a lot of Bitcoiners and a lot of Bitcoin podcasts describe this news item and get it wrong, get it flat out wrong, and actually kind of FUD this news. But that news was that on Wednesday, July 25th, which was last DCA Wednesday, William Pulte, who is the director of the Federal Housing Finance Agency, tweeted out, "After significant studying and in keeping with President Trump's vision to make the United States the crypto capital of the world, today I ordered the great Fannie Mae and Freddie Mac to prepare their businesses to count cryptocurrency as an asset for a mortgage." Now, where people got this wrong, and what I've heard a lot of Bitcoiners saying, including Len and Joey on the Canadian Bitcoiners podcast just the other night, get this wrong. And of course, if you're not from the United States, obviously it's completely understandable, because Canada, for example, mortgages are a completely different animal than they are in the United States. So I would not expect the average Canadian to be as familiar with the mortgage process in the United States as people in the United States are. If you've already bought a home, you've had a mortgage or two, or maybe you are dreaming about having a mortgage and buying your own home, then you know what it takes to get a mortgage in the United States, when people in other countries have reason to not be as familiar. So what a lot of people were saying was that you can only count your Bitcoin towards a mortgage if you have your Bitcoin on an exchange. Ultimately, they were saying it's going to all end up on Coinbase, and that this was a way that the banks could ultimately confiscate your Bitcoin potentially, or that it was going to lock up your Bitcoin as collateral for mortgage. That's what Len and Joey were describing it as you were locking up your Bitcoin as collateral for the mortgage, and that is not the case. This is not posting Bitcoin as collateral. What this is that in the United States, when you go to take out a mortgage, which, if I'm getting ahead of myself, if you don't know what a mortgage is a special type of loan that's used to purchase a house. Well, you need to show that you qualify for this big loan, because for most people, it's going to be the biggest loan they ever take out by far. I mean, 10x or more what you'd pay for a car. So you do this by showing your proof of income. If you have a regular 9-to-5 fiat mining job, you show your W-2s and your work history, that you've been at this job for a long enough time that they should take your income alone as proof that you can pay the mortgage back. But it's a lot more complicated if you're self-employed, or if you're retired, or if you're a trust fund baby, etc. And one of the things that mortgage lenders usually do in that case, and even if you do have a regular job, they usually ask to see what kind of savings you have. They want to see 6 months at least, sometimes 18 months or longer, of your bank statements to see what your cash flow looks like, to see what your net worth looks like, so that they can determine if it's likely in their judgment that you can afford to make the payments on this mortgage and that you're not a risk of immediately defaulting. What this change means is that you can now include your Bitcoin in your proof of assets, something you couldn't do previously. Even if you had it on an exchange, they wouldn't let you count Bitcoin as an asset that shows that you have a high enough net worth that you should qualify for a mortgage. So nothing more and nothing less, basically. They're not requiring you lock up your Bitcoin. They're not requiring that you even keep your Bitcoin on that exchange. They just want to see a history of your Bitcoin on an exchange to prove that you actually have it. Of course, the reason that you have to have your Bitcoin in a custodian and not in a hardware wallet somewhere is not so they can hold it as collateral, as I already said, but so that there's a quote-unquote reputable financial firm attesting to the fact that you have these assets, in this case Bitcoin, that you have the assets that you say you have. And I'm not saying you should move your Bitcoin to Coinbase or any other exchange. Far from it. Not your keys, not your coins. Keep your coins off of the exchanges. I'm not even saying that there shouldn't be a better way, like signing a message to prove your holdings instead of having them on Coinbase. All I'm saying is that this is what the new rules are. And what I will say further is that this is a significant shift in the way banks and the government particularly view and treat Bitcoiners. Remember, just a few months ago, banks were physically discouraged from doing business with Bitcoiners. Not even from custodying Bitcoin or offering products to Bitcoiners, but even offering services to Bitcoiners in general. Banks were closing your account. They were debanking you if you had a history of doing Bitcoin transactions. If you took your debit card and you transferred money to an exchange in the past, you could have ended up with your bank closed. Remember SAB 121? Remember Operation Choke Point 2.0? This was literally just months ago. And in that short time, which is a blink of an eye almost, the Overton window has not just shifted radically, but it has made a 180-degree turn in Bitcoin's favor. And this is just the beginning. So right now, they require you to have your Bitcoin on an exchange if you want to count them as assets when qualifying for a mortgage. But I would expect that, again, this is a radical change. I would expect that eventually, maybe in the not too distant future, all you're going to have to do is sign a message saying, I own this Bitcoin and that's why I should qualify for a mortgage, despite the fact I might not even have a 9-to-5. I might be living on the beach somewhere, which I kind of am, but I have a 9-to-5. But living on the beach and living off your Bitcoin. Remember, it's been less than a year ago, when then President Joe Biden proposed his 2025 budget proposal, which was then adopted by Kamala Harris when she was running for president after Joe Biden bowed out. And remember, that budget proposal included the quote-unquote unrealized capital gains. I mean, it's easy to forget just how much has changed and how fast it's changed, all after just a single presidential election in the United States. One regime that has not shifted gears is the European Central Bank, with the ECB tweeting just a couple of days ago, there is an urgent need to channel retail savings into capital markets to develop those markets and finance EU priorities. An EU savings standard could increase retail participation, benefiting savers, boosting investment, and supporting strategic priorities. What does this mean? This means that the EU is toying with forcing you to spend your savings. This isn't new. Like communism and the budding little socialists attempting to take over New York City right now, Creative ways to confiscate or destroy your savings keep rearing their ugly head over and over again. If you remember back in 2020, it was Canada, with then Finance Minister Chrystia Freeland calling Canadian savings accounts, quote, preloaded stimulus, and asking for proposals on ways the Canadian government could, quote unquote, unlock this money to help it stimulate the Canadian economy. Of course, Bitcoin fixes this no matter where you live. In the United States, fortunately, right now, the government isn't trying to go after your Bitcoin, and it's not trying to go after the money in the fiat that you have in your savings accounts, other than through inflation. But regardless of where you live, whether it's Canada, the United States, Africa, wherever, Bitcoin fixes this. If you hold Bitcoin and you hold it in custody, your custody, it's the only way you hold Bitcoin. If you have a hardware wallet, you control your own keys to the Bitcoin that you have purchased. No one can call that preloaded stimulus. Nobody can try to find a way to channel that to finance their priorities, to finance the EU's priorities, etc. Over the weekend, Bakkt jumped on the corporate FOMO bandwagon, reportedly filing to raise $1 billion to potentially establish a $1 billion Bitcoin treasury. Remember Bakkt? Bakkt was central to a lot of the corporate FOMO hopium in 2018. If you don't remember, Bakkt was formed in the summer of 2018, but even before it was launched, it was a subject of much speculation. It was launched by the owners of the New York Stock Exchange, Intercontinental Exchange, or ICE, the other ICE, and it was going to bring Bitcoin payments and Bitcoin rewards, think airline miles, etc., to the mainstream, announcing plans to enable everyday use of Bitcoin payments at Starbucks, for example, which was an early partner of Bakkt. Of course, this would have been huge, but it obviously never materialized, probably in large portion because at the time, even the Trump administration at that point in time was hostile to Bitcoin. Not as hostile as the Biden administration with their Operation Choke Point 2.0 and Elizabeth Warren's flat-out anti-crypto army, but nonetheless, they didn't exactly embrace Bitcoin in the first go-around. Now, Bakkt is back, potentially joining the race, kicked off by Michael Saylor, most famously, to establish a Bitcoin treasury. Wall Street, of course, continues to expand the number of companies that are jumping onto this bandwagon, Bakkt being just one example of that now. I spoke about the mythical super cycle a little earlier. Apparently, Wall Street is starting to say that this time is different, to call for that super cycle, with the Cointelegraph reporting today. The headline, Standard Chartered expects Bitcoin to hit new highs of 135,000 in Q3. Now, that's not what the meat of this article says. The meat of this article goes on to talk about is that they think the halving cycle is over. I'll get into the article. It says, Global Bank's Standard Chartered is bullish on Bitcoin for the rest of the year, citing increasing corporate treasury buying and strong exchange-traded fund inflows to print new highs of 135,000 by the end of the third quarter and then break 200,000 by the end of the year, according to the bank's digital asset research lead, Geoff Kendrick. Thanks to increased investor flows, we believe Bitcoin has moved beyond the previous dynamic where prices fell 18 months after the halving cycle, Kendrick said, adding that the common halving trend would have led to price declines in September of October 2025. So there it is, saying that instead of having a blow-off top in the fall, and then that big crypto bear market, the Bitcoin winter, and then repeating the cycle after the next halving, they're saying that market dynamics have changed in a way where they think that we're not going to be engaged in that anymore. That's basically the super cycle, saying we're not going to see the big crash. Maybe we see a bear market, but it's certainly not the big crash of 80% or more that we've seen in previous bear markets. I remain unconvinced. Prove me wrong. I would be happy to see Bitcoin prove me wrong, but again, I've given my reasons why I don't think that's the case. But once again, we're hearing people call for the super cycle, this time Standard Chartered Bank. And I mentioned the other companies that were piling in, or other companies piling into the Saylor standard, the MicroStrategy standard, the establishing corporate Bitcoin treasuries. On Sunday, June 29th, the Financial Times ran the headline, London listed companies pile into Bitcoin. London-listed companies are turning to Bitcoin to boost their share prices, drawing Europe's largest equity market into a growing global trend in which businesses are transforming themselves into proxies for the cryptocurrencies. At least 9 companies, from web design businesses to a gold miner, have in the past week announced that they have either bought Bitcoin to add to the corporate treasuries or plan to do so. Farside Investors tweeted on the 29th something similar, saying, "Today we add 4 new London Bitcoin treasury companies to the Farside dashboard. One of the companies, Panther Metals, holds just 1 Bitcoin. Here we are now in the heart of the mania with companies coming to the market." All right, enough news, enough about corporate FOMO, because that's old news in my book. Obviously, it's accelerating, but we've been expecting that. A long time ago, I was saying, before the halving even, that this was going to be the halving cycle that vindicated Michael Saylor, and that vindication coming in the form of corporate FOMO as other companies want to repeat what he's done, and that it was going to be the cycle that vindicates El Salvador with their Bitcoin adoption strategy. And we have certainly, I think, seen that come true, and it will continue to come true increasingly so as that FOMO heats up. Maybe that leads to the super cycle, who knows? Only time will tell. All right, on to what makes today and every Wednesday special, and that is that today is DCA Wednesday. What is DCA, you might ask? Well, DCA is short for dollar cost averaging. And dollar cost averaging is an investment strategy where you pick an equal portion and you invest it at regular intervals without regard to the price. So, for example, we set our equal portion at just $20. I wanted to keep it small enough that anyone listening could relate, and also prove that you're not too late, that even just $20 a week would eventually build us a sizable stack of sats, something I think we've already proven. Of course, we chose our interval to be weekly and Wednesdays to be specific. And so far, we've stacked 205 Wednesdays, beginning all the way back on July 28th, 2021, with that first DCA Wednesday. And in doing so, we converted a total of $4,100 into a stack of 10,785,710 Satoshis, showing that in a relatively small period of time, just less than 4 years, $20, even just $20, added up quickly. If you're listening to this podcast and you think that $20 is a lot of money and that's something that you might be stretching to come up with, that's a you do you thing. You stack whatever you're comfortable stacking. Money that you're not going to need to pay the rent, to buy food. I used to say money that you would blow anyway, maybe on drinks or on going to the movies or dinner with friends and family, or money that would be disposable income, not something that you're gonna need to pay an emergency bill or even just to buy your food. But if you're Michael Saylor, obviously that $20 would mean nothing to him, and he would be stacking a lot more. So again, that's a you do you thing. We chose $20, and if you are in the situation where $20 is a lot of money, imagine having $4,100, and that's what you would have converted by stacking weekly. And of course, that 10,785,710 sats is worth a lot more than $4,100. Currently worth about $11,756 at Bitcoin's current price of around $109,000. We're going to grow that stack again today using the Strike app. I've been toying with the idea of doing an automated DCA because I want to stack every sat I can, and Strike will let you stack for free if you have an automated investment after your first week, that is. And while we're only going to spend about 20 Satoshis stacking today, remember one day that's going to be $20. Or if Fidelity's right and Bitcoin goes to $1 billion, that would be $200 that we blew on fees. So for now, at least for the first 4 years, and we're getting close to coming on the 4-year anniversary, I'm going to continue buying in real time because I think it adds something to the podcast. I certainly enjoy stacking in real time, but maybe after we complete our 4-year anniversary, we'll look into that, because it really does bother me, even just spending 20 sats on fees when we, I don't have a problem with spending sats to support the Bitcoin economy. I don't have a problem with spending sats to boost my favorite podcast. I have a problem spending sats needlessly. And we don't need to spend those 20 sats when Strike will let us do this stack for free. But we'll cross that bridge when we get to it. In the meantime, I already have $20 on strike. I have more than that because I budgeted what I'm going to DCA for the entire month and moved it to strike already. So it's just a matter of tapping buy, entering $20, and of course tapping OK. And boom, just like that, we've stacked another 18,147 sats. We did it at a price of $109,164.05 in US dollar terms. So Bitcoin's continue to trend up just a little while I've been talking. That brings our total to 10,803,857 sats now. And it also increases our average purchase price by another $121. So our average cost basis for those 10,803,857 sats is now $38,134.53. Still pretty darn good considering we just purchased at over 109,000 US dollars per Bitcoin. The beauty of dollar cost averaging is we bought all the way up to the 2021 high, and then we bought all the way down to the bear market low. And of course, now we're buying all the way back up to whatever the new cycle high will be, and then the blow off top. Or if we don't have one, we'll continue buying all the way up to hyper Bitcoinization. But the point being, we purchase every week without regard to price. And as a result, we've purchased at an average purchase price that a lot of people would call lucky at just 38,134 US dollars. So speaking of fiat value, we mentioned that Standard Chartered says that they predict one Bitcoin will be worth $135,000 by the end of the third quarter and $200,000 by the end of 2025. And if and when their prediction comes true, at $200,000 Bitcoin, our current stack, without buying a single extra Satoshi, would have a fiat dollar value, US dollar fiat value of $21,607.70. Not too shabby considering we've stacked only 4,120 US dollars now. When Bitcoin hits that $1 million mark, that magic 1 million, our Bitcoin stack would have a US dollar value of $108,038.57, an absolutely mind-boggling return on just $4,120. Of course, a lot of that is because fiat's going to zero, not just that Bitcoin is consuming and eating the entire world, the entire global financial system eventually. Of course, we mentioned that Adam Back predicted that he thinks by 2032, one Bitcoin will be worth more than $10 million. And if and when that comes true, our current stack would be worth more than $1 million US dollars. $1,080,385.70, a return that would have people writing articles about you like they did in 2016 when they were writing articles saying this one particular kid took his $1,000 he got from his grandma for his birthday and bought it into Bitcoin. He's now worth $1 million. Or, if you'd invested just $10,000 in Bitcoin, you'd now have X number millions of dollars. That's the kind of return that we were talking about, the kind of return that had people saying that we're too late, that those were the good old days, that you've missed out. I posit that you have not missed out, that Bitcoin will eventually hit $10 million or more, and when it does, you'll see why I keep saying you're still early. Now, of course, Fidelity said that by the year 2038, one Bitcoin will be worth 1 billion, that's with a B, 1 billion US dollars. And when it does, our stack of just 0.1 Bitcoin will have a US dollar value of $108,038,570. You will be getting hate from friends and family members that you've been trying to orange pill at that point. The friends and family members who have been naysaying you, who have been calling this the tulip mania, that have been saying you're collecting beanie babies, that just refuse to see the evidence in front of them. That, unfortunately, will remain true until people are forced to buy Bitcoin. I think when we're talking $1 billion Bitcoin, by then we'll have seen hyper Bitcoinization, and even the people that are the haters right now will have been forced to purchase Bitcoin, because that's what you're going to have if you want to buy a house, or if you want to buy a car, or even if you want to buy a cheeseburger. There are going to be merchants out there, just like there's merchants now that won't take cash, or merchants that won't take Visa because they don't want to pay the fees. It seems kind of split. There are merchants that only accept cash, but there are an increasing number of merchants that refuse to accept cash And eventually we'll see an increasing number of merchants that refuse to accept US dollars. They'll want to be paid in Bitcoin because they don't want you to pay them in currency that's going to be worth less by the time they get it deposited in the bank than it was when you purchased the beer or whatever you spent it on from them. Either way, that's not too shabby considering we've squirreled away just 4,120 US dollars and converted it into Bitcoin. And we're going to continue to do so every Wednesday while there are people still foolish enough to send us Satoshis, sell us Satoshis for money that the government can just print for nothing. Before I wrap up, again, I would like to ask you to help support this podcast by feeding that algorithm monster, by rating and reviewing this podcast, by sharing it with a friend. The more listens we get, the more likely your country might end up in the top 10 if it's not already there, but also the more plebs will be exposed to this podcast by seeing it pop up when they search for content to listen to. You can also support this podcast by making sure you're following us on X at BTC Bulletin Pod. That's at BTC Bulletin Pod. The more people following us on Twitter, the more people will see me tweet about this podcast and maybe listen to this podcast and learn that you can buy as little as $1 worth of Bitcoin, or in our case, as little as 20 US dollars worth of Bitcoin, and that you're not too late. I also like to hear from you. So whether you send a shout out or a boost, you can also send a DM. I have Twitter open right now. I have my DMs open at BTC Bulletin Pod, and I do respond to those DMs. I like to hear from you. It makes it fulfilling to know who you are, where you are, what you're thinking, and that you support this podcast and that you're listening. Of course, if you don't have X or Twitter, you can always send me a good old-fashioned email. My email is also open in another tab. My email is bitcoinbulletin@protonmail.com. And if it's not a spam email saying, hey, you should have so-and-so on your podcast because he is the latest altcoin expert and he can tell your listeners how that they can invest in the next Bitcoin, don't respond to those. But if you're a pleb and you email me at bitcoinbulletin@protonmail.com, I do reply to those emails. As I mentioned, don't forget to join us next Wednesday and every Wednesday while we continue to grow this stack just 20 US dollars at a time. But until that time, keep on stacking those sats, you sexy sat stackers.